Valuation terms are confusing to many business owners. Enterprise value, equity value, net proceeds after disposition. What do each of these terms mean, and how are they interrelated? And why should you, as a middle market business owner, manage all three to optimize or exit? Okay, so there's three metrics that are extremely important. If you're looking to exit your business anytime in the next 10 years, you need to understand these values: enterprise value, equity value, and net proceeds. You need to understand the difference between them. You need to understand that you need to manage them differently to optimize each of them. And what you also need to appreciate is that if you don't manage one or all of them properly, you're going to end up with a suboptimal exit. Before we begin, don't forget to subscribe to my newsletter, Enterprise Value. The link's in the description. Reach out to me at value@valorum.ca if you have any questions, or visit my website at valueacceleration.ca. Okay, so what is enterprise value? Enterprise value represents the true value of the business, irrespective of how that business is financed. So let's think about it. How our business is financed? Well, mostly through equity. So the initial owners, whether there's one or there's multiple owners, would have put in money into the business to start off the initial investment into the business. Now, debt is also a way of financing a business, and usually debt's going to come from your chartered banks. They're going to come from perhaps alternative lenders, such as, say, the BDC. You may have shareholders contributing debt as well, so shareholder loans. And last but not least, maybe you're going to have some alternative miscellaneous, third-party lenders. Now, what's important to understand is that third-party buyers are going to be generally more interested in enterprise value than anything else. And the reason for that is that they're not interested in how you've divided your portion of debt versus equity in the business, because they have their own ideas about how they want to do it. And they may have the wherewithal to, for example, to borrow, more money than the sellers of the business might have been able to. And so therefore, they may choose to go down that route. What's important to understand is that enterprise value does not represent what ends up in the seller's pocket after the end of the sale. Okay, so think about it. You're going to have to pay down debt. You're going to have to pay your taxes, and you're going to have transactional costs like commissions. You're going to have consulting fees to your lawyers and accountants, etc. So, you've got multiple things that you're going to have to use those funds. So if somebody pays you enterprise value for your business, you're still going to have to draw a bunch of things down, debt and other obligations to complete the sale. So sometimes we talk about country club valuations. And so somebody's bragging about what they got for their business. They may be bragging about their enterprise value, but they're not really telling you what actually ended up in their pockets at the end of the day. And that's the point to understand. There's a big difference between enterprise value and what ends up in your pocket at the end of the day. So this is what we're going to talk about in a few slides down the road. So the equity value of a business represents a claim against the residual value of the business once all obligations have been considered. So by obligations, I generally speaking mean debt. And in more complicated situations, it could also involve other classes of shares, such as preferred shares. So equity value is going to equal enterprise value less the value of debt. And if there's any preferred shares, the value of preferred shares. And so that's step number one, is figuring out, okay, what is 100% of equity value? What is it? How do we calculate it? And then the second thing is going to be, how many shareholders are there? So if there's multiple shareholders, we got to figure out what each of their portions are going to be. And again, there's some complexities there on how we value minority interests, which I won't get into today. But we're going to have to partition the equity value between the different shareholders. So keeping in mind, in most cases, equity value is going to be less than or equal to enterprise value. And that's important to understand, is that, the more shareholders you bring on board, the more you're going to have to slice that piece of pie up to allocate out, partition the value of the business when you go to sell it. The net proceeds after disposition represents the net dollar amount that accrues to a particular shareholder after all debt has been retired, all the taxes paid, and all the transactional costs have been considered. In transactional costs, we mean things like commissions and consulting fees. I would think in almost all cases, the net proceeds are going to be lower than your enterprise value and lower than your equity value. And there are many factors that can influence your net proceeds after disposition. So we talked earlier about the country club valuation. Well, the country the person who's bragging about, at the local country club is probably not bragging to you about their net proceeds. They're probably either talking to you about the equity value or they're not talking to you about enterprise value. But the net proceeds is important because this is the actual real pool of money. Assuming you're retiring, this is the real pool of money that you're going to be investing afterwards and using to support your retirement. So this is the number it's important. But when we get into the next section, we're going to talk about how we have to manage all three of those metrics: enterprise value, equity value, and net proceeds, to optimize an exit. So how do we manage each of these three metrics? So enterprise value is going to be managed through value creation activities. And if you read my blog, you'll know that I've talked about the concept of value acceleration. And what it really involves is the growth of the business and the de-risking of the business. And by growth, I'm talking about the growth of the EBITDA, or the cash flow, not so much the top line growth. Equity value, in contrast, is going to be managed through the prudent use of capital allocation practices. So how is the business going to be funded? Okay, so in a lot of cases, some businesses may have too much debt, and that's obviously not a good thing. But there's a lot of examples of businesses, especially in the middle market, where the owners has been traditionally been risk averse and not use debt. And the reality is that if you're going to enter into some sort of value acceleration kind of program, maybe you're going to need some debt to help finance some of that growth. So again, smart use of debt, can help to fund some of the growth that you may be interested in doing. And the net proceeds after disposition is going to be managed through your traditional tax planning, insurance planning, estate planning, and business succession planning. Okay, so let's walk through some examples of how poor planning can result in a suboptimal exit. Now, I said at the very beginning, I said you have to manage all three of the metrics, and a failure to manage all three of the metrics is going to result in a suboptimal exit. So let's give examples for each of the metrics of how poor planning can hurt you, and then we'll talk about how they're interrelated. So on the enterprise value side, a lack of value creation strategies is going to result in a suboptimal exit. And for a lot of middle market businesses, they do not engage in any sort of well-defined value creation strategies. And the reason for this is twofold, I think. Number one, most business owners have never been educated properly on how value creation works and what it's all about. And number two, They've not given themselves enough of a runway to perform a proper value creation program. And I've said this before, that I think you need at least 3 years minimum to be able to properly plan and implement a value creation strategy. And the lack of creating a value creation strategy is going to result in the worst case in a transferability issue where the business just can't transfer, can't sell it. You have to shut the doors. In a better case, it may result just in a lower multiple. So in other words, the business sells, but you're not going to optimize the multiple. So on the equity value side, here we're talking about either insufficient or poor use of debt. And the reality as it relates to debt is that, some businesses either don't use debt don't use it enough of it, or have used it very poorly given the economics of the business. The other side of the equation is on the equity side is that, you've given equity to business partners who really aren't carrying their weight in the business. They're not, and the reality is that that equity is actually very expensive because as we mentioned before, it's a slice of the pie. And so if somebody's not really contributing, they're just a silent partner, but they've got equity, sometimes that can be very, very expensive. Now, net proceeds are going to be addressed through tax, insurance, estate planning. So if we have done a poor job of it or just haven't done it at all, the reality is too much money is going to either, it's going to basically flow out in terms of taxes or probate, or it's going to go to places that we don't want it to go. It's not going to go into the owner's pocket. So that planning has to be done ahead of time. There's a lot of tax planning, for example, that needs to be done a minimum of 2 years ahead of time, because you can't do certain tax planning in anticipation of a sale. That creates some tax problems. So again, even at the very bare minimum, some of the stuff really needs to be done, 2 years ahead of time. Okay, so how are all these things interrelated? Well, let's just think about it for a second. So if we can maximize enterprise value through value creation strategies, it just makes sense that the value is going to flow down through the chain. So, we maximize enterprise value. Once we remove debt, equity value is going to be better off. And assuming we've done some, tax and insurance planning and estate planning, the net proceeds after we've exited the business are going to be higher. But we also have to think about some of the other metrics as well. Equity value, if we use debt wisely, if we use equity investments wisely, and an equity investment, for example, could be involving bringing in an equity partner. It could be involving private equity. But if those investors, shareholders, are bringing a lot to the table, it could be a situation where we as the existing shareholder we have a smaller piece of the pie, but a much bigger pie because of the contributions of those partners. So that's an example of how good capital allocation can help us out, or good use of debt, because maybe we use debt to fuel some of the investments we need to make to improve the business. Okay? The last part is the planning surrounding net proceeds. So tax planning, insurance planning, estate planning, exit planning, etc. If we optimize enterprise value and equity value, but we don't do any half decent tax or insurance planning or estate planning, there's a lot of money that can get, let's put it this way, it's going to end up in the wrong It's not going to end up in our pockets. It's going to end up in someone else's pockets. So you could grow your business and be a business genius, but basically blow it at the end because you didn't do any proper tax planning or you didn't do it quickly enough. So I think it's important to understand that each of these metrics is interrelated. And if we can make steps to optimize each of these metrics, we are going to be in a position where we can at least improve our chances upon exit of having the best possible exit that we can in terms of, the valuation, but most importantly, like the money that's sitting in your pocket at the end of the day. Okay, so wrapping it up. We're all about holistic exit planning at Valorum, and I believe that a holistic exit plan should incorporate a plan for enterprise value, equity value, and net proceeds after disposition. And this plan should be undertaken a minimum of 3 years before exit. So thanks very much for watching today. We'll see you next time.